Hey everybody, Mike here. Today we are going to continue with our discussion about market impacts. And today we're going to focus on the retirement years. Okay, what happens when the market does what it did over the course of the past year? And as we look to answer that question, I'm going to give you a quiz. Here's the scenario. You start with a balance of $100,000 in an IRA, and over the course of 10 years, you earn an average of 12%. And then you withdraw $12,000 per year. What is your balance at the end of 10 years? Okay, there's your four options there. It's easy math, right? You gain 12%, which is $12,000, and then you withdraw that $12,000 each year, so you'll still have $100,000 after 10 years, right? Well, unfortunately, real life ain't so simple. The real answer is that it depends. But what does it depend on? Well, it depends on a couple of things, a couple key factors. One, did you ever have a loss at any point during the 10 years? Notice I said you earn an average of 12%. That doesn't mean that you earn 12% each year. Your average of 12% could include a loss at some point during those 10 years. And then it also matters, when does that loss occur? Okay? So, we're going to look at a few different scenarios and figure out how this works. Okay, scenario number one. Let's say you take a 10.5% loss in year one, and then you earn 14.5% for each of the next 9 years. Your average rate of return is 12%. Now here's what the table actually looks like for that. Okay, you can see that the account value is dropping because once the loss occurred in year one, you begin withdrawing at a higher rate than you're earning it back. You're no longer earning $12,000 a year, and you're still withdrawing that. Why? Because you're in retirement and you still need that $12,000 to live on. So what about the last year? I referenced what happened last year, and in the previous video, I mentioned that the average IRA balance was down somewhere in the 21 to 25% range. Let's say someone's dropped 19.5%. So this was not at all uncommon in 2022. Well, here's what the table would look like for that. In this case, answer D in the quiz could be the correct answer, right? You can see how drastic that 19.5% loss was. Okay, and then you could earn, in order to earn the average of 12%, you would need to earn 15.5% for the remaining 9 years. One last scenario. Oftentimes you hear financial advisors say that their accounts average 8% returns per year. Okay, in this table here, the average rate of return is 8.85%. Okay, earn 12% for 9 straight years, and then lose 19.5% in year 10. So we're using this drastic year that we had in 2022 as sort of the example. You had 10 or 9 good years before that, and then all of a sudden, boom, crash, right? So what does this do to the accounts? All right, you're averaging 8.5% according to the numbers, or 8.85% according to the numbers. But that loss in year 10 all of a sudden hits your account hard. Okay? Imagine being in retirement and seeing your account do that. What if you needed that money to sustain you for another 15 or 20 years or longer, depending how long you live? If you wanted to earn, here's the other kicker. If you wanted to earn the $12,000 that you needed in retirement, see, the first 9 years you were earning the $12,000, you were withdrawing the $12,000, so you weren't touching your principal. What if you wanted to get back to that? You wanted your account to stay at $68,500 moving forward, but you still needed the $12,000 to live off of. Well, in order to do that, you would need to get annual returns of just over 17.5%. Okay, if you don't, if your returns go back into the 8 to 12% range, then you'll watch your account go to zero within the next 6 to 10 years. Okay, so this leads me to Warren Buffett's 2 rules for investing. First, never lose money. Second, never forget rule number 1. Okay, sounds like kind of a no kidding statement, right? But what I just laid out for you is exactly what he's warning against. It can take one bad year to erase a lifetime of hard work. Now, if you're looking for something safer than the markets to place your money in, that's exactly what I do. A dividend-paying whole life insurance policy not only guarantees that your money will never go down, but that it will grow even when the markets don't. It will be there for you when you need it. Okay. Now, if you are interested in learning more about this, maybe how it could work for you, I'm going to continue to put out more videos, but like and subscribe to this YouTube channel. Make sure that you share this with your friends. Let's grow the knowledge base on what the powers of dividend whole life insurance are. Okay. And if you want to reach out to me, I'm going to put my contact info and our website in the show notes as well. Okay. Until next time, we'll see you.